Hello, traders. The theme today is I made a mistake. It's going to happen to everyone. If you trade long enough, you're going to make mistakes. So I'm going to go over exactly what happened, and I'm going to use my pick from a week ago. I really liked selling a Tesla out of the money bullish put spread. So to set the table, the market had been trading sideways. Tesla had announced earnings. The reaction to the earnings was pretty good. We had multiple levels of support. Didn't really see much of a market threat. Felt that the stock was going to be able to hold those support levels. I'm trying to take advantage of accelerated time premium decay. I sold the Valentine's Day, February 14th, 365 puts, bought the 360 puts. I did that trade for a $1 credit. So what happened? Well, the trade was on. Everything looked good. Nice shape. No issues with the trade. And then we get the clamor about tariffs being imposed. Uh-oh, Monday morning, the market's going to sell off. And that's cool because the next pick that I gave you actually worked out really well. I gave you a bunch of picks, actually. So we'll take a look at those as well. I was short futures Friday, heading into the weekend. I knew that those tariffs were going to be hitting. So I had a bearish posture going into the weekend. I also owned some 600, 595 bearish put spreads, put debit spreads for Monday's expiration. So the truth is that I was very bearish heading into Monday morning. S&P futures tanked. Everything according to plan. Everything looks good. So I've got this put credit spread out there on Tesla, and I'm watching the stock pull back, and I'm thinking, what do I need to have this thing on for right now? I got the market ticking lower. I have the stock ticking lower. I need to have both pieces of this puzzle working in tandem for me to attempt to leg out of a bullish put spread. And this is a very dangerous maneuver. I do not suggest it for any novice trader, okay? You are going to be taking on an incredible amount of risk, and this is going to fly back right in your face. So the best thing you can do if you have a spread that's working against you is buy the spread back as a spread. Do not try to leg out of it. For those of you who are professional traders, different story. You've been doing this for a long time. You're going to be patient. You're going to know when both conditions line up. And so it's critically important that when you buy the short strike back, okay, this put is closer to the money. When you buy that put back, all of a sudden, your position has gone from neutral to slightly bullish for Tesla to flat out as bearish as you can possibly be because you are now long an out of the money put option that expires in 2 weeks. So you're completely exposed to time premium decay. Exactly the things that we like to short, you are now long. A stock that you were neutral to bullish on, you are now as bearish as you could possibly be. Well, how could that happen, Pete? How could you flip from being neutral to slightly bullish to just flat out bearish? Well, the stock was breaking below a technical horizontal support level. Plus, I felt that the market still had plenty of downside. And so on the right here, you can see the S&P 500. And we're going to go back and take a look at this stock on a longer term basis, but I really want to set the table for you for what transpired. So the market tests the upside a little bit, gets into the gap just a touch, and then tick, tick, tick lower. Now we have a new low of the day, and the selling pressure was pretty steady. What did the stock do? Tick, tick, tick lower. So at this juncture, I thought, I can buy back my Tesla 365 puts. I'm expecting the stock to continue to drift lower. I'm expecting the market to continue to drift lower. Both are moving beautifully in that direction on what? on heavy volume. The news backdrop is bearish. It's no bueno. China says they're going to retaliate. Canada says they're going to retaliate. Mexico says they're going to retaliate. So everything is in a flux Monday morning. I'm short futures. I'm long a put debit spread. Life is good. Let's get rid of this bullish put spread. Let's buy this thing back. Let's leg out of it. And so I thought, okay, I'm going to buy my 365 puts back. I bought them back for $11.50. I instantly put an offer out to sell my 360 puts for $10.50. So, paid $11.50. If I could sell the others for $10.50, I'm going to be able to do that for a $1 debit. Well, I put the whole trade on for a $1 credit. So I get to scratch a trade that wasn't working out well. And I had everything lined up and it was working beautifully. The options that I was trying to sell were 1030 bid, offered at $10.50. My offer. I just needed the stock to move a little bit lower. Just another 20, 30 cents might have gotten me filled on those options. Well, what happened next? Let's fast forward and take a look. Whoa! Look at that pop in the stock. The low was 374. The high was 383. That stock moved $8 in a 5-minute bar. Ugh. Oops. What did the market do? Oh, whoa. The market rallied 50 S&P points in a 5-minute bar. How did that happen? Well, Mexico's president was meeting with Trump. Mexico's president said, hey, we're going to put 10,000 troops on the border. Instantly, Trump said, okay, we're going to delay your tariffs by 30 days. And the news came out that fast. So there was no scheduled press conference. There was nothing that would indicate to me that this news was pending. All I needed was another 5 minutes in the trade, 10 minutes in the trade. I'm going to be filled. I will have successfully legged out of the position. I wasn't being a pig about it. I wasn't trying to actually make money on the 360 puts that I was long. I was just trying to get out of a trade that was not working out. And I knew that I didn't want to be short Tesla via puts that were out of the money and that were going to expire in a couple of weeks, that were extremely exposed to time premium decay. Those, if I'm going to be short the stock, those are not the options that I want to pick. Okay, I'm going to give myself lots of time. I'm going to buy in the money options. That's how I'm going to prefer to trade it. Options that expire in 2 or 3 months, so that I have cushion. I have the ability so that if the stock takes a detour, I'm not exposed to time running out on me. How many times have you been in a position and you think, well, I'm only going to be in the position for a few days, so I'm going to trade weekly options. I'm going to trade options that expire in a week or two. And the next thing you know, the stock takes a little bit of a detour, doesn't even have to be very much of a detour, and you watch those options expire worthless. You lost money on the trade, and as soon as that expiration rolls over a week or two later, you go, dang, there goes the stock. I was right. I didn't give myself enough time. When you're buying options, you need to make sure that you are not exposed to time premium decay. You should always be short options that expire within a month's period of time. You should try and be long premium 2 months out, 3 months out, deep in the money, high delta. Options that have a 0.7 delta are going to move 70 cents on the dollar with the underlying stock. Those are the ones that you want to take a position on when you have a longer term swing trade, not buying options that are going to expire very quickly. So I hope I'm making this point perfectly clear. So now what happens? Well, when I had this gigantic big bar up, now the S&P is in the overnight gap. I knew it had to be news related to the Trump tariffs, and now you've got this big volume coming in. So I took a 50-point gain on my S&P futures. I took a 100% gain on my put debit spread. But to be quite honest with you, I needed the SPY to be below 295, and I think it was trading down around 292 for the good part of the morning here. I'm thinking I'm going to make a triple on this, and that the SPY is going to close below 595. So was I happy that I made 100% on that put debit spread? Yeah, but I was actually expecting more. I did not expect for this big of a move. If the market was going to continue to go lower and lower and drift lower, I would have been more anxious to take a profit on my short futures position somewhere in the 100-point range, 120-point range. And so I would have been scaling out of that position. I wasn't going to get greedy with it. And as far as the put debit spread, I was going to kind of wait to see how the day played out. If we had a bearish trend day without really any news, all I had to do was get through Monday, because those options were 0 DTE on Monday. They were going to expire and settle at the close Monday. So all I really needed was no big market move higher. Well, we got the big market move higher. So I thought I would let the day play out. I wasn't going to panic on my Tesla puts. And as I watched the stock didn't really rebound very well. You can see how the market rallied up and then it kind of compressed on that news. Didn't quite get to the gap. And then it just kind of flatlined there the rest of the day. Tesla, on the other hand, you can see how it kind of struggled. So it tried to fill in a little bit of the gap and it rolled over. And so by the close of the day, I decided this is a losing position. I'm going to close it out. I don't want to be short this stock. These are definitely not the options that I would want to be short. If the stock showed me that, yes, this is a good short, I can always change my mind and take a longer term bearish position in Tesla. It's always open to me. But for right now, these are not good puts to be long. And I still don't know what the heck the market is going to do either, because it's in this trading range and it's trading off of news. We had a big jobs report coming out. We had news from Google pending, earnings news. We had news from Amazon coming out. So last week we still had plenty of news in the cycle. So why would I want to be long these Tesla puts when I don't have any confidence in that position? So let's take a look at Tesla. I'm going to go over the bullish put spread and what it was intended to do. So we're going to take a look at that daily chart. And some of you might still be in the position. I'm going to address that as well. So this is where the news came out. Right in here, you've got the gap down. This is what I was leaning on, was this horizontal support right here. I was leaning on the 50-day moving average right in here. You can see earnings announcement there where the A is. And the stock jumps up after the earnings announcement. Everything is fine. This is Friday's price action. Everything is fine. So I'm leaning on the 50-day moving average. I'm leaning on this horizontal support right in here, which actually broke down. And I was leaning on AVWAP-E, this general level down in here. So that's why I sold the 365 puts and bought the 360 puts. I was leaning on that support. The support gave way. That's the price action on Monday. So it had not convincingly given way, but look what's happened since then. The stock has been drifting lower. The stock is showing signs of weakness, because what has the market done during that time? The market's generally been higher. Sure, we sold off Friday. We had the jobs report. You can see how the market sold off Friday, but before Friday, the market had actually been inching its way higher very nicely. But the stock had been ticking lower. The stock is weak relative to the market. Tesla is your pick of the week. I like Tesla on the short side. I like Tesla to go down to the 100-day moving average. So what do I do? Pete. Oh my gosh. I am currently short that bullish put spread. I'm still short the 365 puts and I'm long the 360s, and now it's in the money. Well, the first thing I want to tell you is that when you have these spreads on, you don't have to panic the first time that the spread goes in the money, because you're not going to get assigned, okay? And you don't make decisions on a swing trade based on intraday price action. You need to see what the stock does into the close. During the day, you get all sorts of movement back and forth, and you don't really know if those moves are going to hold or if they're going to reverse. And so for swing trades, it's imperative that you do not make your decisions on exiting a trade, a swing trade, during the day. Let that price action settle out, and then make your decision 10 minutes before the close. All right, it looks like the stock sold off. It looks like the stock is weak. It was not able to bounce, wasn't able to recover its losses. Now I have that information, what support levels I was leaning on. The stock has been able to close below them. Okay, I'm going to exit the trade. The other thing, when you have a bullish put spread on and you're trying to take advantage of a flat market, a dull market, let's say that the market pulls back a bit. Okay, well, you didn't really expect that, and it wasn't anything nasty. It was just a normal market dip. Now, if the stock dips below the short strike price and it's completely market related and the market's not falling apart, it still looks intact, and the stock pulled back for that reason, I'm kind of okay with that. I'll let the stock sit there, and you can even see relative strength in the stock. When the market is pulling back, the stock is treading water. The market pulls back, the stock goes a little bit lower. As soon as the market finds support, the stock is trying to work its way higher. Those are all fine situations, especially if you're like $1 in the money. You know that as soon as the market finds its footing, the stock is going to be back on track and it's going to get above that short strike price. Where you have to be particularly careful with this is that you are watching for that relative strength to continue in the underlying stock. If the market is flat and the stock is ticking lower, it is weak relative to the market, and the reason for the stock pullback is not the market, it's that there's selling pressure in the stock. Then you have to be very careful when those options go in the money, because the stock has lost its relative strength. And because when we sell bullish put spreads, we are always selling those put spreads below support. So from the price of the stock currently, there are going to be at least 2 support levels before we get to our short strike price in this strategy. As those support levels fail, that's where we expected to see buyers. That gives us extra cushion, extra odds for that trade working out successfully. Well, when those support levels fail, we were expecting to see buyers there. They either weren't there or they were overpowered by sellers. Now we have a problem because those support levels have failed. And when they start to fail, that also gives us more conviction to legging out of the spread. So if you currently have Tesla on, I mentioned to you earlier, you must wait for this setup. It is critically important if you are going to leg out. And again, if you're a novice trader, please just close the spread down. If you got to pay $2.50 for it, pay $2.50 for it. Whatever you got to pay for it, reel it back in, okay? Losing trade. Wipe the slate clean, and then you can consider the trade that I'm going to be currently showing you, which is still shorting Tesla, but we're going to go out in time and we're going to buy options that are further out in time. So when I take a look at Tesla and what's happened, now I've got these breaches of the 50-day moving average. We're below AVWAP-E. We're below this horizontal support level. The stock has been weak relative to the market. All right, I got all the things that I need. Now I just need some market weakness. I don't know how the market is going to open up Monday. So before I can tell you anything, I better get my market bearings, okay? See what the heck the market's been doing. By the way, we'll take a look at some of the other trades that I've shown you as well. Market bearings. Look at this gibberish. Up and down and up and down and up and down. And what have we done in the last 3 months? Nothing. This is just a spattering. If you just took red and green paint and just spattered it on a white canvas, this is probably what it would look like. There's no freaking trend here at all. The market is just chopping around willy-nilly. So you do have some resistance here near the all-time high, and you can see how every time we test it, we get these long red candles and there's a pullback. All right, so are we going to pull back Monday? I don't know. What's the week look like next week? Well, we've got CPI and we've got PPI next week. Not huge market movers. Okay, there have been some subtle signs that inflation might be increasing, but in general, the market is pretty comfortable trading in this neutral zone. There hasn't been any bad news. Even the jobs report on Friday, 148,000, I believe it was. Okay, they're looking for 176,000. Now, I see some flaws in the jobs report, and I believe that there are not as many jobs as the government is currently reporting. If you take a look at JOLTS and you take a look at the future job openings, you look at what Challenger Gray and Christmas says about new hiring and proposed layoffs. There's some softness there. We did see initial jobless claims move a little bit higher, but in general, the market is not in panic mode because the economic conditions are continuing to be okay. They're not strong. ISM manufacturing came out. It was a little bit better than expected, but not much. ISM services, which accounts for 80% of our economic growth service sector, that was actually pretty soft, somewhere around the 52.4 range. That is starting to move closer to the 50 number. Anything below 50 indicates economic contraction. I look around globally, I see negative real GDP growth in Europe. I see China absolutely struggling, and that's the biggest piece of the puzzle as far as I'm concerned, because that's the second largest economy in the world, and their economy is pulling back considerably. So you're not seeing it in the numbers, but you're seeing it on the ground. So if you lift up the hood and you take a look at what's really happening in China, you can see signs of deteriorating consumer demand everywhere. They are cutting back in a big way. So if you don't have that global economic growth engine, where's the growth going to come from for the U.S.? Now you add in that there are going to be tariffs imposed on China. That's only going to make their situation worse. There's a lot of uncertainty, and you got valuations right now at an all-time high. So the bottom line is this choppy, crappy price action is going to persist until, and I believe the day is coming, until we start to see some weak economic numbers. Okay, and they're going to start piling up. The first handful of weak economic numbers are going to be dismissed because the Fed has room to ease. Oh, well, when the Fed starts to cut interest rates, they're going to stimulate economic growth. Everything's going to be okay. Buyers are conditioned to buy dips. Bull markets die hard. Okay, so any transition from a bullish market to a bearish market, it's usually going to have this type of choppy back and forth price action. Same thing is true when the market transitions from a bearish market to a bullish market. You're going to get that same type of choppy, crappy price action, just like we had here back in late 2022. This kind of garbage. All right, horizontal trading range, spattering of red and green candles all over the place, plenty of volatility, buyers and sellers paired off. Eventually, the market lifts off, and now you have a nice bullish trend. Well, we're seeing the same thing here, except this is a market that I believe is going to be transitioning into a bearish market. And so what happens after you get more and more economic weakness bearing out in these data points is that the Fed keeps cutting and cutting and cutting, but to no avail, because the economic growth, the economic stimulus is not helping. It's not increasing consumer demand. And when you reach that point, that's when you start to see some of those market sell-offs Central banks around the world have already been in that mode, okay? Bank of England, they cut rates. We've seen the ECB cutting interest rates. China has been cutting interest rates like mad, and it's not helping to stimulate economic growth. So they're already down that road. They're already there. We just haven't quite gotten there yet. And so I don't have the technical confirmation. I don't have the breakdown. I don't have the bad news to get sell, 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 sell. It's not there yet, so I'm not expecting it. I expect this kind of choppy, crappy price action to continue until we get those numbers. So I'm still favoring the short side, and that's why I'm going to give you a bearish pick like Tesla. So we get this market drop on Friday. Notice that we are above the 50-day moving average. So this goes out to those of you who are still in that bullish put spread. I need to see the market break below that 50-day moving average with a vengeance, with gusto, with long red candles on heavy volume. When I get that type of move, then I'm going to know that I've got nice consistent price action on a 5-minute basis intraday where I can consider legging out of this Tesla spread. And I need Tesla every time the market goes down. I need Tesla to go down. When the market is flat, I need Tesla to go down. When the market rallies, I need Tesla to go down. I need to see that type of selling pressure. When you get a green candle in here anywhere, you want to see it immediately erased. You get some green candles in here, I want to see it erased immediately and quickly. That tells me that sellers are still motivated and that they are acting with a sense of urgency. So get a couple green candles, blam, you get a nice red candle that erases them. That tells you, that's your price confirmation. That tells you that it's still all systems go. Whatever price you paid for those 365 puts, try and get $1 less than that for the 360 puts, and that will scratch the trade for you. I would not hang on to this trade for an overnight position. They expire Friday. Okay, so you don't have a lot of time on legging out of this. It's going to be better for you to just shut it down, losing trade, put it behind you, move on. We've had tons of great trades. You're going to make the money back, okay? So this one didn't work out, but it's all right. Don't take the added risk. If you're a pro, I've told you already the situation you need to look for. And because these options are going to be expiring on Friday, you have added risk. So you have to be able to leg out of the spread very, very early in the day. It has to happen in the first hour, okay? You are not making this decision an hour before the close. You need that day so that you got plenty of time for the stock to move down and for you to be out of that trade. Again, whatever you paid for the 365 puts, you are trying to sell the 360s for $1 more or $1 less, and you've got the order working. You are not going to play games with this. You're going to just try and get out of a losing position. So what would I do if I wanted to initiate a position on Tesla? Well, I'm going to be looking to go out as far as I can on Tesla and hopefully get at least a month. So I could go out to the March expiration. It's going to give me about a month and a couple of weeks or so. I could even go out to the April regular expiration, and the stock is somewhere around 362, I believe. Yeah, let's call it 362. So the 370 puts, I mean, these are just flat out expensive. That's Tesla for you. I mean, these options trade, they're liquid, so you can get in and out of the options, but they're super expensive because the stock moves. So the first caveat is that the SPY has to be below the 50-day moving average, and it has to break that level substantially, crisp, heavy volume. If you're not paying attention and you are not paying attention to the market, you're going to force the trade and you're going to regret it, okay? Because the market's not giving us a whole lot to work with. We need that breakdown, and we need that breakdown to be convincing, because only then can we hope to have a little follow through intraday. I'm not looking to put long-term swing trades on. I don't know what the hell the market's going to do here. I'm looking to do some very quick day trades, perhaps at very most have an overnight swing position on. That's it. Okay, I'm day trading. I've been telling you that for about the last month or so. I am day trading. So from a day trading perspective, you can short Tesla stock. That's probably the route that I would go, because you don't want to have to navigate wide bid-ask spreads if you're going to be day trading, all right? You can just short shares of stock. If you're going to be taking a position, then I would be looking to go out. You don't necessarily have to go out to the April expiration. You can go out to the March regular expiration Friday, and you can take a look at maybe the 370 puts. Those are trading 28.35, 28.70. You can see there's a 40-cent bid-ask spread. That's wide, okay? That's a lot to navigate in a day. So if you go with the 375s, you can see they're in the money by about 12 points or so. You're paying a heck of a lot of time premium for those options right here. You can do some put debit spreads, weekly options, but your timing has to be impeccable, and I don't want to make this video any longer than it has to be. But yes, you could use a put debit spread, and you could be trading the 360, 355 put debit spread, but you'd have to be able to buy that for like $1.35 Monday morning. I'm not sure where that would even be trading. Let's take a look. Let's see what we've got. Please don't ask me for follow-up questions on a speculative trade like that, because if you don't have the confidence to trade it, so right now that 355, 350 put debit spread, you're looking $1.65, $1.95. You might have a little time premium decay over the weekend, but you need to have that crackdown in the market. If you get that break below the 50-day moving average, then this would be a nice trade. But I'd like to get in somewhere around the $1.40 range would be good, $1.35 range. And then I'm only looking to maybe make 40 cents on that trade. I'm not looking for this thing to go to the $5 max, because I want to be in, I want to be out, I want to time the market. Okay, that's the mode that you have to be in. Sorry to make this a lecture, but I know I have a variety of different traders who are watching this, and if I'm not forceful in the way that I say things, there are so many different ways that you can go wrong on a trade like this. And so these are very important points. Okay, so there are a number of different variables that have to be taken into consideration. Long-term context for the market, long-term context for the stock, short-term context for the market, short-term context for the stock, the option strategy that you're using, the option implied volatilities. All of this comes together, okay? So if you're seasoned, it's second nature to you. If you're a novice trader, you're doing a trade that you absolutely have no right to do. If you're honing your skills, best thing you can do, trade one share of Tesla. If the market breaks below the 50-day moving average with gusto next week, you short one share of Tesla. If the stock is weak relative to the market, and we have ways to measure that. We've got real relative weakness in Option Stalker Pro, and I'm looking for the stock to be able to get down to that 100-day moving average. If you're a novice trader and you're trying to leg out of this bullish put spread, you're going to have your butt handed to you. Just buy it back, take the loss, move on. We'll have plenty of other trades that we're going to be able to make that money back on. So as far as my mistake, what would I have done differently Monday? Zero, nada, nothing. Had everything I needed. It was working out perfectly. I had the market coming in perfectly. I bought the options back at a decent price, I felt at the time. I had the stock coming back beautifully. I had my offer out there for the 360 puts. I was almost filled on them, and then out of nowhere, the market ran up on this tariff news. There was no way to predict that a statement was forthcoming or what it might possibly be or what the market reaction could have been. I got caught, okay? Sometimes you're going to get lucky. and it's going to work out for you. Sometimes you're going to get unlucky and it's not going to work out for you. So the good and the bad, when it comes to just pure timing and luck, it tends to balance out over time. But I didn't make what I felt was a trading mistake. If you presented me with exactly the same situation, I would have done it the same way 100% of the time. But I think what's important is for you to understand that when I came in Monday and I closed everything down, I still had a great day because I made money on my shorts. But when I came in Monday, that I didn't hang on to that position overnight simply because I couldn't take a loser. I exited it, I took my hit, took my medicine, and I moved on. Okay? But I didn't compound the problem by hanging on to some puts that were exposed to time premium decay, where any little rally in the stock would have made the situation much, much worse. So let's take a look at some of the stocks that I showed you last weekend. I had mentioned to you that the market was going to be pulling back hard on Monday morning. I believe Apple was one of the stocks that I showed you. Apple did pull back hard Monday morning. We can kind of zoom out and maybe I'll go into a 15-minute chart. That'll get me there quicker. There's your gap down. Apple was a really nice pick. Stock sells off, so if you shorted it near the open, you did really well. If you shorted it on the low of the day and then you had to weather that tariff bounce, you still had an opportunity to make money on the trade because the stock made a new low for the day after that relatively weak. Okay, you could have even loaded back up on the position. PII was another short that I gave you. All right, let's take a look at that one. So you get short in here. Oh, I'm short. Oh no, here comes the tariff stuff. You had this big rally above VWAP even, and you could have re-entered that short position, added to it, not re-entered. You're still with it. You get blindsided and you're thinking, what the hell's going on here? What is this? What do I do now? So you're in the gap and you're watching the position because you shorted in here. Let's say you shorted on the absolute low of the day. All right, well, you get this big rally up, and now you're seeing the stock give it all back. When it breaks below VWAP, you can add to the short position. You shorted here, let's say you didn't short here, which would have been really nice. Let's say you shorted down here on the low. Now you add to the short right here. Stock makes a new low of the day. Take your gains on the whole enchilada. Thank you very much. I think LVS was another one. That stock also, same deal. So those are the three stocks that I showed you. And I had mentioned to you last week that I felt the probability of the market selling off Monday was very, very high. And there you can see, there's your low of the day on Monday. And you can see that the stock made a lower low on Monday. So no matter where you sold those shares short, you had a chance to make money on those trades. On Wednesday, I showed you CPRI. Very weak, nasty little stock. Let's take a look at that D1 chart. Kawaka. Look at that thing get sold off. And that was after an earnings announcement. And that was a price action on Wednesday. So there was an opportunity to make money on that Wednesday. I kept watching the stock. Thursday, I see this big run up to the 50-day moving average. Smacka, smacka, smacka. I am shorting stock up here as soon as the stock came back through that 50-day moving average, which it was at 22.67. I think I shorted somewhere, my average price was somewhere around 22.50, if I recall properly. And so here's what happened. There's your rally up, and then I see this long red bearish engulfing candle, and the market was basically floundering around. It wasn't doing a whole lot of anything ahead of the jobs report. And so I shorted here on this breakdown below VWAP, and it was back below the 50-day moving average. And I added to the short in here, which put my average cost way up here. And I covered that short down in here. I made better than 50 cents on an ad, and the stock is $22 stock. That's a really nice trade. That is a really nice return. CPRI was a great pick. Tesla, we're going to redeem ourselves because we have new information now, and that new information comes to us in the form of price action, and the stock after earnings has shown us that it's got some relative weakness, and I believe that the stock has a clear path down to the 100-day moving average. The missing element is the market. If the market is not weak, we do not trade it. I would love to see a weak little wimpy bounce on Monday and then Kawaka Tuesday. Maybe it's on the CPI number coming in a little hotter than normal. You get that crackdown. Whatever the news is going to spark that selling. The market breaks that 50-day moving average with ease. Then I'm looking to short Tesla if it continues to be relatively weak. And I'm looking to set my sights at the 100-day moving average for a target profit. So I hope all of you have learned from this lesson. I make mistakes, it's part of trading. I really view this more as bad luck than anything. If I had bought back my short put 5 minutes earlier, I would have gotten out at a better price, and that would have allowed me to hit my target profit on the 360 puts 5 minutes earlier. I'd have been out of the trade. I was almost out of the trade as it was, and I would have been able to scratch the trade. If I would have waited 5 minutes longer and not bought those puts back, the news would have been out, and then I could have evaluated the trade in a much different manner, but I didn't do that. So I hope all of this has really helped you understand how to leg out of positions, how to leg out of bullish put spreads, what the intention of that particular option strategy is. It's a great option strategy, especially when the market's neutral. When you have those multiple levels of support, you've got a stock with high option implied volatilities. You can distance yourself from the action. Those are all reasons to do these bullish put spreads. They're great trades. This one did not work out, and now I'm starting to see some underlying weakness in Tesla. I think the stock is going to continue to move lower. So I like it for a short this week. I also like some of the apparel stocks on the short side. Watch out because some of them are announcing earnings, but just off the top of my head, VFC is a nice short. NKE, Nike is a nice short. Crocs look like a good short. SKX, Skechers. A lot of these apparel stocks have been particularly weak. So keep an eye on those stocks, and we may actually have retail sales coming out a little bit later this week. And then we also have the retailers themselves who are going to be announcing earnings. So keep things pretty fluid. You can trade both sides of the market. You just have to pick the right day to trade it because the market's kind of moving sideways. And I'd really like to see this break down below the 50-day moving average since I'm focusing a little bit more on the short side. That's what's going to give me the comfort to be a little bit more aggressive trading shorts when I see that type of market breakdown. Please subscribe to the YouTube channel because I'm going to try and do some of those short videos, a few more of those during the week. I don't know when I'm going to have time to release it, but if you've got your notifications on, you're going to know when those new trades come out. CPRI was a beauty, man. There's some really good opportunities to short that stock on Friday. Give the content a thumbs up if you like it. I hope your team wins in the Super Bowl. We will see you Wednesday. I'm going to do a live event with Harry. We decided to do a live event. I had to cut back on them. Just too much going on right now. And I'm going to make time to do a live event on Wednesday, so make sure to watch for that. Thanks so much, everyone. Trade well.
Thank you for watching this YouTube video. I'm Pete Stolzers, and I'm going to keep the trade ideas coming along with lots of education, so make sure to subscribe to the channel and please turn on your notifications so that you never miss another trade. If you like the content, please give it a thumbs up. I've loaded 2 other videos that I think you're really going to enjoy. Stay tuned. We'll see you soon.